Okay, welcome back. If you're just joining us, wishing all of you a very happy Diwali from the entire team here at CNBC-TV18. We've, of course, been in conversation with various managements on the back of earnings, and let's welcome in the next one. Kaynes Technologies reported numbers for the second quarter. Numbers are largely in line with expectations. Margins have expanded. Revenue growth has been aided by strong UPC growth, while profits have also surged near 90% on a year-on-year basis. We have the management now joining in to take some questions. Jairam Sampath is CFO at the company. Jairam, good to have you with us here. Good morning. Season's greetings to you and your team, your family. Thanks very much for being with us here. I just want to start with the margin beat that you've reported. What were the drivers behind the margin improvement that we've seen, and what can we expect in H2 and the full year FY25?
Yeah, thank you, Prashantji, and a very happy Diwali and a nice New Year to all of you and your viewers. See, fundamentally, margins are driven by two things. Okay, one is at the gross margin level, which is driven by the mix of the business. We are, as you know, a diversified portfolio company. So we have 6 different business verticals. So there were more business probably we did in industrial vertical with a slightly better margin. So there was a margin improvement. The second driver of margin is also the kind of leverage you get. So we think that in the second half, we will be benefiting by both of these drivers. So probably we will do almost twice as much as what we did in the first half in terms of revenue. So that will give you good operating leverage. Plus some of the verticals, which are high yield verticals for us, will also be firing up. As you know, there have been some small delays in the government spending taking off, but we see sure signs of these coming up now. So you can expect in the second half slightly better performance on margins and so on. And so we think that it will be probably a good margin expansion in the second half, leading to about 15% plus kind of EBITDA at the end of the year.
All right. Hi, Jairam. Good morning and good to see you in. This is Nigel on this side. On the revenue front, if you could give us a sense, will it be closer to 3,500 crores? You're saying 3,000 crores is the guidance, but you're not ruling out a beat out there. So what could that number be? Margins, you've told us it should improve in the second half, so we'll maybe take it at more than 15%. And also, I wanted your order book breakup between the segments. You've got the absolute number, but between segments, if you could break it up for us.
Yeah, so at this stage, we would still maintain 3,000 crores plus. And we do see a lot of bullishness in terms of order booking, and some of the customers are coming back with more and more commitments for the future. Maybe by third quarter, we'll know more clearly how much more we can do. But this 3,000 crores plus is certainly very high probability. And of course, we do have better margins also coming up due to the reasons that I said. So in terms of color on the order book, right now the order book is dominated by industrial and automotive segments. And we have some railway and some aerospace and those segments coming up now. So post, let's say September, in October, November, December, we probably will see some increase in the order booking in those segments too. It has taken maybe due to the election quarter, the first quarter was election quarter. So there was a kind of delay, but I think it will all pick up now. So we think that we'll exit this year with a fairly good order book, not only in terms of numbers, but also in terms of those sectors which are high yielding for us.
Okay, all right. In the longer run, how do you see the smart meter segment shaping up? There's a big potential over there, but what is the revenue outlook as a percentage of the total, industrial contribution? What can it give?
Yeah, so see, right now we are looking at about 15%, 15 to 20% of the total market of smart meters in India domestically. Smart meter business has got 2 parts. One is domestic, and then I think slowly the international or the export portion will also come up. We have a very large European client, and we have kind of got approvals from them. And then maybe as the domestic business stabilizes, then the export business will also start off. So I see next 5 to 10 years time frame. This will be a significant portion. I think at a peak, we will do about 1,000 crores of smart meters on an annual basis based on whatever capacities we have planned. So I think it will be fair to say that of the total revenues, maybe this year smart meters might be just about 10-15%, and then going forward, it probably will remain similar because the other businesses also will grow. And so that's the outlook on the smart meters.
Okay, let's talk semiconductors, Mr. Sampath, because that's what the market gets really excited about, right? So how are the sort of plans and the works coming along for the Gujarat facility? And also now, do you have some more clarity on how the breakup is going to be between OSATs, what perhaps could be the revenue potential? Some more details now on semiconductors.
Quickly, so the land acquisition is completed and we have started the construction there. And hopefully, by end of the year, we would have the lines coming in, and maybe we'll establish in the first quarter and we'll do the POC line, which is called proof of concept. And we should get approvals in place before the first half of next year. And then by fourth quarter, we should start doing reasonable revenue. That's 40% of, let's say, what we call the phase one implementation. And we have now better clarity in terms of how we are going to have, who is going to be the anchor customer in the beginning stage, and then how the entire thing is going to shape up. So we think that for a total capex of about 3,300 crores, the revenue potential by, let's say, FY30 should be close to about 4,000 crores of revenue. And the way we have configured and the way we have strategized and planned our capacities is that this should be margin accretive compared to the existing businesses. And so we are trying to be future ready in this business. Yes, right now we have huge amount of support from the government on capital subsidy. But going forward, we think that this business should be able to generate resources by its own to add capacities beyond the 3,300 crores that we are talking about. So yeah, going is good. We have got the team in place and some of them are camped in Gujarat right now. And so maybe by the next quarter, you will know better about how the building is coming up and so on. And yeah, first quarter of next year, we should probably have the POC running and maybe some customer approvals. Though we have promised by fourth quarter FY26 commercial revenues, we are trying hard to advance it by a couple of quarters, so that
your investors will absolutely love that, sir. Like I said, it's the buzzword, the hot area right now, right? So you're saying fourth quarter of FY26 for sure, maybe even earlier than that is when the first revenue starts coming through. You also mentioned that the margin is going to be more accretive. Typically, how much, as you look at the calculations right now, what will be the gap between, say, the blended margin? Right now, you're talking about 15% EBITDA margin. With this business coming through, how will the margin profile improve and change?
Yeah, so see, we have to look at both the things. One is margin, the other is the ROC. So we are more worried about the ROC because these are capital-intensive businesses, right? So they give you 1 to 1.5 times the asset turns. So we are quite acutely aware of the fact that margin cannot be 15%. It has to be something like a 27% kind of number. And we think that may not be by Q4 of 26, but eventually by FY30, we should have a margin which is 25-27% kind of number on EBITDA. So that we do have a fair chance of giving a 20% plus ROC to the investors. So this is how we look at it. And because the EMS business is asset light and it has 6 to 7 times asset turns, so a 15% EBITDA with whatever profile of working capital that we have yields a fairly reasonable ROC. So we are trying to balance out all. See, we are also looking at the sustainability of the business on its own.
Right. So, Jairam, if I can just come in. Yes. Sorry, apologies. CG also was one of the players which got the PLI, right, along with you and Tata's yes, for this business. If my memory serves me right, maybe wrong, and apology if I am. They said that margins would be 16-17% in this business. Are they doing? Is it something very different?
Yeah.
What they're doing?
Yeah. So I mean, this similar story to what EMS play is. So it depends on what exactly you do. The margins will differ. So there are two, let's say broadly for the purpose of this discussion, we split the entire assembly parts into two. One is the legacy kind of work, which is predominantly what perhaps the other players are doing because they have one anchor customer and they move the legacy business here. That's also good to do if they have large volume and they have some other strategies in mind later. But in our case, 25% of capex only we are aiming towards the legacy production. The other 75% is aimed towards what is known as advanced packaging. And we let's say, there's a bold initiative on our part. What we are straddling this entire advanced packaging, one at the entry level, which is like stacked dies and 2.5D, etc. And one at the other extreme high-end level, which where we'll do prototyping, etc., which is like the co-packaged optics and so on. So what we are trying to do is, while we find our feet in this business through legacy packaging, etc., we quickly transition to be a company which can be trusted to do advanced packaging, and especially for the new products. So that is the strategy right now. So I think we will get there, because there is a gap in that particular part of business with a lot of front-end fabs trying to develop as OSAT for advanced packaging. So we think that companies like us and some other people who set in capacities later, if they do it for advanced packaging, I think the margins in advanced packaging are far superior to the legacy packaging. Legacy packaging is the kind of number that you're talking about, and advanced packaging will be twice as much actually.
Okay, this requires a full
Half an hour.
other conversation, but it's a new line of business and lots of excitement here. Thank you very much, Jairam, for joining us. And once again, wishing you a very happy Diwali from all of us here at CNBC TV 18 Market.